It is Tuesday, December 17th. We have Bob Morris who's going to talk to us about energy and why it's kind of flailing here into year end. Ben Bry, with finger on his nose, the pulse of what's going on in the markets. We just finished our 6 a.m. West Coast, 9 a.m. East Coast time pre-market update. Bob, let's start with you. Are people just doing tax loss harvesting? Is it you and I were talking before the show started? Is this just really about sorry, my kid's looking at me like I'm crazy. Is this about the weather being cold? What's I mean, not cold and people wondering if they're gonna get enough juice out of the energy squeeze this winter. What's going on here?
Yeah, I think people are growing a little bit skittish on energy just because of both oil and natural gas prices. And, I've said several times over the past few weeks, it's a lot easier to make a bear case than a bull case for crude oil prices right here. Oil is demand out of China,
Hmm.
which continues to disappoint. And we saw yesterday when the retail data came out worse than expected in China yesterday, oil prices came off because that all underscores China's economy and the demand
Right.
growth that everybody's looking there. And I think this morning China came out and said they were targeting 5% growth this year, and the market kind of shrugged and said, "Okay, yeah, whatever."
Okay.
Um, and at the same time, natural gas prices, we pointed out last week that we were really dependent on the weather to get a big lift in natural gas prices this year. And winter weather's not playing out so far. It's 55 degrees here today. I went out running earlier this morning in a t-shirt. And
Wow.
so, you know, typically people by the end of December tend to make a call on the full winter, whether it's going to be colder than normal or not, because midwinter is the second week of January. You get to the end of December, you've had the first half with the forecast out for the next 10 to 14 days. You kind of know how the first half of the winter is going to play out. And we had said before with the storage overhang going into the winter, we needed a colder than normal winter. We're not getting that. And I think we're getting close to the point where people are going to say, we're not getting it. So, what I've said here, I haven't been buying anything. I'm watching very closely. And one of the names I've been looking at that's interesting is that I hadn't looked at it in a long time, but it's Comstock Resources, CRK. And Bakes pointed out last week that it was one of the best charts in E&P land that he'd seen.
Mm.
And I hadn't looked at the name in a long time, but I went back and looked, and it's interesting because this is a pure play on natural gas. It's 100% natural gas in the Haynesville Shale along the Gulf Coast, easy access to LNG in the future. But the thing is, it's a highly leveraged play on natural gas. The net debt to book capitalization is close to 50%. In the first quarter, they suspended the dividend, and Jerry Jones put in another $100 million to take his interest from 65 to 67%. So this is almost a $5 billion market cap name that Jerry Jones owns 67% of. He's doubled his money since he put the 100 million in the last tranche that he put in here, and the stock's up 80% year to date. So it's the best performing name in the E&P sector because I think people are sort of buying this name in anticipation of any sharp move up in natural gas prices. Now, the fact that it's levered is typically when you're looking for a big move up in the commodity price, you want the levered name. And I'm looking at their cash operating costs. A third of their cash operating costs is interest expense. Um, but they still have a pretty low overall cash operating cost structure relative to most of the gas levered names, which is sort of interesting in that, yeah, you want the leverage for the impact of every dime on the bottom line margin, but they still have pretty good margins relative to their peers, even with interest expense being a third of their cash operating costs. So it's a name that I'm putting on the radar screen. I need to do a little bit
Okay.
more work on the valuation, just given the huge run this name's had year to date. But as Bakes pointed out, it's a very nice chart. It certainly looks like, depending the outcome on the valuation, a levered name you would want to play on any sharp move up in natural gas prices. So I'm doing some more work on it. It's intriguing. I'm putting it on the radar screen, and just wanted to point that out that if you're looking at a pure 100% natural gas play, you say small cap, it's almost $5 billion, but a name that with much higher gas prices should do very well in paying down that debt and having that leverage to higher gas. So we're keeping an eye on that, not buying it right here. As you know, I really haven't. I bought a little bit of a starter position in EQT, but have not stepped into the gas names here yet. Long term, we're still very bullish on natural gas, but near term, still being hesitant or careful here. So,
So
bottom
Bob,
line on
when
it.
you come back to us, can come back with the assessment of, lever names are great when rates are going down. And obviously we
Mhm.
should get 25 bits cut here. I'm sure it's baked into the numbers, but um, understanding what people expect in the current stock price for the rates versus, you know what I mean? So
Yeah,
what's already baked in, and if it's too dovish, then I'd be concerned, right? Because then people are going to get disappointed, et cetera, et cetera. But if they're not too dovish, then that'd be something good to know too. It would be backing your potential bullish bet on it, right? So just trying to understand where expectations are of the analysts are like that'd be super helpful, at least from my perspective.
yeah. Particularly on this name, is most of
Right.
the other names have really paid down their debt, and they don't.
Right, right. Like
You
they
know,
shored things up the last few years, but if someone's still kind of out there, then you really want to have a sense of, well, not just relative to their peers, but individual, standalone. What are people expecting, such that if they get disappointed or become things go better than expected, what's baked in? So where's
yeah,
the
because
asymmetry, if there is some?
you probably can't break it out. It'd be interesting to know of that eighty
Well, you
percent
can
move
read
year to
the
date.
analyst, right? Like, what are the analysts saying? What are they putting in their models? Yeah,
Yeah.
yeah,
Now, it'd
right.
be interesting to be able to break out how much of that 80% move year to date is just lower interest rates given their leverage. It's hard to break that out,
Yes,
but
yeah. Well,
but
but
it
you can kind of see what they are writing about, right? So that's what I would
yeah.
do. I would check that out. Ben, what are you looking at this morning that you want to share with people?
A couple things. First, as we talked about earlier, is that when we look at the board, you just see momentum decay all over the place, with the exception of, I guess, Tesla and Bitcoin. And it makes sense. It makes sense if you think about at the end of speculative periods, you get narrower and narrower.
Yeah,
You got a fewer and fewer names carrying everything. We just had 11 days in a row where we had more losing stocks, declining stocks than advancing stocks. That's the first time it's happened since 9/11. Sorry, I don't want to get that door in there, Nadine. I know you hate that door.
I
Um,
love the
and
door.
so and so I try to please. And so but on our longbow board, we're seeing it too, where you're seeing names that were coming up as buys before it was short, like the high frequency momentum indicator and the slower momentum indicator were kind of bullish and trending positively, and now you're starting to see them kind of erode, and some of them starting to turn. And there's no better indicator of that than Nvidia, right? So I was contemplating shorting Nvidia, and I've talked about shorting Nvidia numerous times. No, what do you mean? It's down to 127. It's down $5 since I talked about that. You can say what you want. You're just scared to short. You're just not a. You're
Not at
not
all.
really as much. You're not a short
No.
seller. You gotta have. You gotta be a
That's
little.
not true. That's not true. Just this year, it wasn't the
That's why
best
it's
time to be
now.
doing it. But then now, then this is the time it's better. It's just you're just thinking. So for everybody's edification, it's just that we've had some back and forth on restoration hardware. That's all it's about.
Yeah, which is at 408 last. And
Yeah.
um and so giving back almost the entire move, which Jeff Mackey would be happy to hear, because after that print, he said, "I have no idea why this thing's up." But again, I think that it has been a good year to short. It just hasn't been a good year to short the index. There's been all
Yeah.
kinds of stuff to do.
For
There
sure.
was a
Yeah.
good there was a good short opportunity in a lot of stuff in March and that April. You had a great short opportunity in June to that August 5th low. You had some great shorts that were government related. I caught that Kinder Care and the Booz Allen Hamilton one. And it's just about positioning. I don't think, yeah, okay,
Sure.
shorting the S&P is a mug's game
Yeah.
anyway. Even if the S&P goes down, guaranteed that
You
wasn't the
don't get
best
that
short
much
out
change.
there
Yeah.
in that
Yeah.
market.
Yeah.
You know what I mean?
Right.
Anyway, so I'm just saying that, like, the S&P 500 was at almost 4,200 around Halloween of 2023, right? And now we're at 6,100 and change. That's a pretty damn big move.
Yes.
Like, that is a sizable move. And when you look around and you think about the buckets being full, they're just, I look at names and I'm like, wow, that's pretty expensive. And like the names that I really like, Bob's area, with the exception of LPs, which are fairly valued, I'd say. I wouldn't say they're overvalued, but like they're not cheap as they've been the last couple of years, right, Bob? I
Right.
mean, and so energy's out of favor, but there's a supply and demand dynamic. I can understand the concerns, and but like, I just look around and I see a lot of opportunities to either just lighten up and see what happens, or to maybe start taking some pot shots and buying insurance. The S&P's realized volatility is at the 0 percentile on a 5-year look back. Wouldn't be a bad time if you don't want to sell and trigger
Right.
those tax losses for this year, and you're seeing like the market's a little squishy today. Maybe the Fed comes out and is a little bit hawkish tomorrow. Who knows? But like the point is buying June, protection isn't bad. Buying the SJB, as I've recommended on this show, as a cash replacement where you can get some exposure to credit spreads blowing out, and it's a fairly user-friendly ETF. Some of that kind of stuff, once again, seems decent to me, and I was pretty adamant about that stuff for this kind of thing in May and June of this year. And I think that it seems like another time where the risk reward doesn't seem great, with the exception of certain names. And by the way, Bob, I love that you're getting on business with Jerry Jones. You think he's better at the gas owning business than at the football owning business?
Right now it appears so. I mean, since he put $104 million, an additional $104 million into Comstock in March, he's doubled his money since then.
Yeah, and all
Stocks
the
up.
Cowboys do is lose. So yeah.
Yeah.
Is there any other nat gas names you like? As we come up, it's a good thing to talk about, actually. So nat gas has one of the better fundamental. If we want to talk about good fundamental stories, nat gas is a decent fundamental story.
Yeah.
But there is a lot of supply. I mean, but like as we come up these next 2 years, two and a half years of these trains coming online, and just more adoption, is the forward curve reflecting this enough, or do you think that like the forward curve is wrong? Like when you think about nat gas right now.
I mean, I think the forward curve, I think there's more upside than downside to the forward curve. And,
Okay.
the fundamentals are very bullish. And you look at some of these, Google and Amazon investing in nuclear to provide some of the electricity supply. Nobody today is building small modular reactors. It's not going to happen. Natural
No.
gas is going to be the power source for all this AI build out, bottom line. And that's going to be very bullish for natural gas. Yes, there's a lot of supply out there, and we can turn on, another few BCF per day at the flip of a coin. But the long-term fundamentals are still very bullish. And you've got LNG build out too. And a lot of this, gas is going to be going into these LNG projects. So long term, I think everybody recognizes that the long term fundamentals for natural gas are bullish. The thing people are struggling with is when you step in and buy these names.
The timing.
And
Yeah.
the timing. The safe bet is to say, gee, well, if all of a sudden it turns wicked cold in the second half of the winter, I'm going to miss it. So let me buy a little bit now, just to make sure I've got that exposure. Maybe I have to wait 6 months or 12 months or whatever. I don't see I don't see huge downside to the natural gas names. We go back 10 years and there was this sort of bullish outlook on natural gas, and people were buying the names are a little bit early, and 6 months later it's like, oh no, it didn't move as quickly as we thought. But now it's 6 months out now. I thought it was 6 months out 6 months ago, but now that we're 6 months down the road and it hasn't happened, but it's going to happen now. It's 6 months out
Yeah.
still. I'm not selling the stocks. I'm not bailing on them. It's still going to happen. The only time you bail is when you say, wait, the fundamentals have changed. I was dead wrong about the fundamentals. I don't think we're going to be dead wrong about the fundamentals. I think, if anything, there's going to be more demand for natural gas just because that's going to be the primary source for all this power generation. It's not going to be these small modular reactors or anything else. And it's particularly under the new Trump administration, I think they're going to be more lenient on approvals for some of these pipelines and infrastructure and everything that we're going to need to put in place to use natural gas as a fuel for this power generation.
What do you think has the most convexity upside? If I'm like, hey, I want to be bullish natural gas, 2 years, 18 months, what would you say has the most upside right now, basically?
Among the names, among the
Like,
stocks,
Yeah.
Yeah, like what could I make multiples of my money owning if I was bullish, I guess. If I were gonna get
Yeah,
like a 5 to 6 handle on the forward curve relative to the 350, 360 that's in there now for 26, 27, like what really rips in that scenario, I guess.
I think the two names that come to mind first are Expand Energy and EQT. Those
Mm,
are both 90%, 96% natural gas. Um, you know, a lot of leverage to the upside, good names. Maybe Comstock. That's why I'm doing work on it because it is the levered name. I got to see where the valuation falls out on that. But those would probably, if CRK meets the criteria on valuation, those would be the three names that have perhaps the best upside from here. The other two names I have on the radar screen are Range Resources and Terra. And another name, sort of a stealth play on natural gas, is CNQ. I like CNQ because they're oil
yeah.
sands and the margins and everything, but they're the second largest natural gas producer in Canada. So they've got huge leverage to natural gas prices too that people often overlook.
And with the run in EQ2, it's still a buy?
I'm looking for a little bit of a pullback. I bought a 20% position in EQT here recently, and I'm
Okay.
sort of keeping an eye on it here to step in and buy
Okay.
more.
Okay.
I mean, I'd
Yeah.
like to have a full position in EQT probably by middle of next year. So I'm sort of
Okay.
being patient here, watching what it does.
Got it.
And again, Expand Energy is, that's the new, I talked about them. That's the old Chesapeake. And I think people have sort of overlooked it since it came out of bankruptcy, what, 2 years ago, 2.5 years ago? Great
Yeah.
management.
Yeah. And interesting. So in the arrows today, I wrote about how I think it's a Goldman report. People are using options for this market versus the names themselves. So I think people are expending less dollars, but still trying.
My screen froze. I don't know if you can hear
Yeah,
me.
mine too. I don't know if you heard, but
Okay.
basically, I think Goldman's
Yeah.
out, and I was writing a note about how people are using call options to mirror the bet that you're talking about versus putting money in the names themselves. So they're kind of counteracting the duration issue by using options.
Yeah. I wonder how expensive those options are when you look at some of the names. You know, if you lose all the value in the option versus the downside in the names, I don't know if that's a good way to play it or not. Because I don't think there's huge downside in the names. I mean, the names got whacked coming out of last winter because
Right.
we had a warm winter and gas prices got hit. But we're a lot closer to those fundamentals playing out to the bullish side now than we were a year ago.
Hmm. Anything else, guys, for today?
I mean, I will say that I'm looking at CVS. My buddy had talked to me about it as a short a little while ago, and I didn't short it. And I was looking at the CDS yesterday for one of our projects, and 70 basis points. That seems like a little tight with Walgreens at 600. That maybe those bonds are a sell or CDS is a like because the equity's just getting smashed as these PBMs come under fire. I don't know if I'd short the equity today, but like I just started looking at that as well. That might be something put on people's radar.
We were talking probably the one big move of the today you should do is just go over to Walmart for your pharmacy needs versus CVS and Walgreens.
Agreed. That was the takeaway of the day is that I'm going to switch my pharmacy from Walgreens, which trades at 600 basis points, to Walmart, which doesn't ever go down.
Yeah.
It's the best stock ever. Like just choose your pharmacy based on the stock chart. You know what I mean?
That's
To me,
right,
it's pretty
that's
easy.
right. Like, make real life decisions based on stock prices. That's really the takeaway we had this morning.
Hey, stock prices are supposed to be a reflection of fundamental reality, right? Isn't that kind of what most of us like to think?
On that note, I think we're going to wrap it up here. December 17th, 2024, Wall Street Beats. If you want to get more insights from the team, I can see here David has got a note out on Teva. Teva's popping. Got to become a subscriber to get the behind the scenes data analysis and insights from the team. But we'll catch you back tomorrow on the show. Thanks so much.